All right, fantastic. Well, I'm pleased today to be here on the Decision Room with my guest, Andy Galpin. He is the founder of Tree and Leaf Partners, a values driven search fund looking to acquire a business to run for the long haul. We'll unpack how he evaluates companies, protects founder legacies, and thinks about how he would lead post acquisition. Welcome, Andy.
Thanks so much, Joshua. It's a pleasure to be with you, and I'm excited to jump into our conversation today.
Yeah, absolutely. So I see you're in Dallas, but you're from the UK. You want to maybe just give a little bit of background as to seen a lot of people relocate from the UK, but not necessarily Dallas being first on the list. So be curious to know a little bit about the story here.
Yeah, my accent gives me away a little bit, and I don't quite get away with saying I'm from a little further east in Texas, but
Right.
maybe it'll change over time. So originally from the UK, born in between Bath and Bristol, grew up in the southeast, just outside of London, and spent the early part of my career at IBM, helping our clients design more meaningful experiences for their customers and employees. And I really love that. But as a consultant and as an advisor, you can give advice until you're blue in the face, and it's up to the client on whether they're actually going to drive a change in their organization off the back of that, even if the advice feels really obvious to you. And I'm sure you can relate to that, Joshua,
Yeah.
in your work. So for me, I got to a point where I wanted to transition to the other side of the table and really be owning and driving change on the other side in an organization. So for me, that was a pivot out of consulting across the pond, and I actually landed in Chicago initially. Did my MBA for 2 years up in Chicago. A little bit more of a kind of natural transition, shall we say, from London and from the UK, and then ended up in Dallas because I met my now wife, who's from Dallas. So once I finished and wrapped up that program, we got married and settled in Dallas, at least initially, and then we will transition to wherever the business is that I end up finding.
So yeah, I know you're not the first, MBA grad or MBA who decided instead of, you know, going back into an operating company to form a search fund, but seems like you're trying maybe a bit of a unique approach in your efforts. So can you describe that a bit?
Yeah, so I named my firm Tree and Leaf Partners, and that's after a collection of short stories by the English author J.R.R. Tolkien. Got to have a little nod to the Englishness in me. And that story is a story he wrote in between The Hobbit and the trilogy. And what most people don't realize is it took him 30 years to finish the trilogy. And this story kind of captures the immensity of the task he felt was ahead of himself and the vision he had for what that trilogy would be and what that would become. And for me, that story is about a painter who gets lost in the detail of one leaf rather than painting the full vision that they have for their painting. And that resonated a lot with me in terms of the conversations I wanted to have with owners. I wanted to connect with businesses whose owners had visions that were much bigger than their lifetime. And we've only got a short time here on Earth, and then we've got to go home or go somewhere else. Businesses can outlast us, and that means our legacy can go on and keep having an impact and a positive change in the world if we find the right person to pick up that paintbrush and start building out that vision. So for me, that was the ethos I brought into the search. I wanted to find people with a vision bigger than themselves that really cared about how the business was run, the values that were instilled within that, and the vision that they had for that business going forward, and really wanted to find the right match for that company. Someone who could steward the employees, steward the customer relationships, and steadily grow and build the business to have a bigger and bigger impact, but wouldn't be someone who comes in and turns the business around and sells it to someone else in 3 to 5 years, which is your typical kind of private equity approach to small business acquisitions. Because for me, to really grow a business and to have an impact in the long term, you need to have a long-term mindset. So we take more of a longer term approach to that, where we don't have a specific hold cycle. So we don't have a fund that we have to return capitals to investors. We have a group of investors that are committed to doing this in the long term. And while I'm the right person to run that, because I also know that I have limitations, I will be the one running that company and growing it in the long term.
So since that's a little bit different model, how do you find investors that are willing to buy into that approach?
Yeah, part of it's about finding people that care more about long-term value creation than short-term returns. And a lot of investors, partly this is down to the stock market and our ability to kind of liquidate our assets very quickly in the public markets. But in the private markets, that takes a little bit longer. And a lot of value is destroyed by needing to sell something too early or not being able to think about things in a bigger term. So I've found capital providers that are aligned with that longer term investment horizon. They've got patient capital that doesn't need to be liquidated very soon, and therefore they can deploy it and leave it in a company for a long time to drive long-term value within that. I've also looked for people who are aligned on the values that I have and the ethos that I bring to the search. And I describe myself as a redemptive acquisition entrepreneur. And all that really means is we're looking at business as a way of driving change within society at a broader level. And therefore, we've got other value creation metrics that we're looking at that are not just financial. So we might look at kind of the concept of human capital or social capital or natural capital. How is the business building that up in their organization? And how can we protect and steward that for the long term? So it allows investors to think about their investment strategy a little bit more holistically, rather than separating kind of, I invest here to make financial capital and then I have my philanthropic dollars that kind of drive human and social capital. It gives them more of an integrated strategy to say kind of, I care about these elements and therefore I can drive both a financial return and a human and social capital return by investing in this organization that's focused in this specific area.
So work with some companies that have been backed by investors who kind of, I would say, particularly say from the Nordic region. I've seen this where
Yeah.
their point of view is almost, we'll hold on to it as long as we feel like we're the correct steward for the investment.
Yeah.
Is that an element of your approach as well?
100%. Because just like myself, I know I will have a limitation. Whether that's 100 million in revenue or 500 million in revenue, I don't know. But I think there's a humility in approaching that to know that I won't always be the best person to run that company. And I think the same is consistent on the investment side. My investors are not narrow specialists. They're more generalists. They invest in lots of different types of companies and bring that broad perspective to the investments that they're working with. We might reach a certain size where we need a specialty capital provider who has deep industry expertise within that space that helps us unlock the next kind of stage of growth within the company, as long as they have that alignment with long-term value creation in how are we building other forms of capital within the business. So one of the challenges is both stewarding that business well when you're running it, but also when you're transitioning it to different investment partners. And I may stay on in between those different capital providers as long as I'm the right person to run it, or we might bring in someone else to run that, and we may hold the investment for a longer term if I've capped out before my investors have.
And I don't have your website open in front of me at the moment, but you listed some pretty interesting folks as partners, a couple of whom I know or I'm familiar with. And I don't know if I'm using that term right or you used a different term on the website, but is that group separate from the investors or is there some overlap that you don't have to share specifics, but I'm just curious if that group kind of plays a different role versus the role your investors play.
No, the group of individuals are all represented in my cap table. So there's a heavy overlap between the people who appear on my website and the people who are investing in the fund and driving this long-term vision.
Got it.
Yeah.
And I mean, why? Like, obviously, you can put together slides or put together a one pager and lay out this vision, but they have to have confidence in your ability to execute. So, as someone who is still, relatively early to mid stage in career cycle, what do you feel you bring to the, table? Is there something about your, leadership approach? Is there something about the specific screening criteria you developed and sort of
Yeah.
that value prop you described? What's the combination there that gave them confidence to back you in this?
Yeah. For me, it starts by understanding what are some of the key challenges these small businesses have, and therefore how can we add value to them as we grow those businesses. And we're focused in the lower end of the market. So our kind of potential relationships with business owners tend to be running businesses around 2 to 8 million in EBITDA, or around 10 to 50 million in revenue. So we're right at the smaller end of the market, not at the bottom, but in the smaller end where they've kind of reached maturity. They've got a good, stable form of revenue. They've got customers that are loyal to them and they're growing at maybe a steady rate. But a lot of businesses get stuck around that phase and around that size, because the skills you need to start a business are very different to the skills you need to grow and scale a business. And some people have both of those skill sets and other people don't. For me, for example, I'm not a founder. Building something from scratch is really outside of my skill set, because it requires constantly changing and adapting what you're doing to respond to the feedback that you're getting in the market. Now, my background, I spent 6 years at IBM, and I would come into clients, understand how they engaged with clients or interacted with their employees, help them understand what that process looked like, and then rebuild that process using technology to be more efficient and to scale to a higher volume. So that's the skill set I bring down market to some of these organizations that haven't really had a systems approach to how they think about building and growing their business. And it often tends to be a very founder-led, founder-run organization. That's another transition that some people struggle with more than others, that when you're in a startup, that founder is making all the decisions and responsible for driving all the outcomes across every area of the business. As that business gets bigger and bigger, that founder needs to delegate more and more responsibility to other people in their teams to enable them to scale. Otherwise, they reach a certain size where the founder can only do so much and the business stops growing there. So we also bring a slightly different perspective into how I would run the company, because often that CEO is either transitioning to a role that they're much more excited about. I talk to a lot of software companies, and often the founder is a bit more technical. They're really excited about the problem that they've solved and building the solution. But as the company has grown and scaled, they're responsible for payroll, they're responsible for HR, they're the main salesperson in the organization, and they get very, very distant from what they actually enjoy doing and where their core skill set is. So one option is they pivot into more of a CTO role, and they get back to what they really enjoy doing. And I can come in to help build that administrative side of the business that enables it to scale from that perspective.
And so can you share any of your other screening criteria besides the revenue and EBITDA ranges that you provided?
Yeah, so we have a basic screening criteria that focuses on some financial metrics, because financial metrics are very quantifiable. They're very black and white. We can look at them and determine if they fit or if they don't. But we're also interested in other forms of capital, kind of how the business is investing in its employees, for example. So we tend to find that information a bit more qualitatively through the conversations we have, either with the business owner, a representative that they're working with, or employees if we get the opportunity to access them, or third-party sources that kind of give us a pseudonym of that. So we'll talk about kind of how have they invested in their employees over the last 3 years? What do their benefits look like? Often their benefits program, is it I'm paying the bare minimum and giving my employees the bare minimum that I can get away with? Or am I being intentional about how am I enriching my employees' lives and adding value to them above and beyond the bare minimum? So we look at kind of how they do that, how much of their budget is spent and invested in that, if they have any NPS or EPS results, so employee net promoter score and things like that. We'll look at that data and feed that into our analysis. And then we might even speak to competitors or customers or potential customers within their industry to try and get a sense of how they're viewed in the marketplace. Is this a partner that people like working with and enjoy engaging with, or are they a struggle to engage with? Because our reputation tends to precede us. And if we don't act in the best interest of the broader ecosystem, then the other partners in that ecosystem become aware of that quite quickly, particularly if you're looking at a very localized business that engages with the community quite closely.
Yeah. So it looks like you've been at this for a couple of years now. So I'm just curious, like, does the search fund have a time limit on it to find a business. You know, again, without sharing anything too proprietary,
Yeah.
any examples you can share of maybe businesses you got down the road with, but just didn't materialize into a deal for whatever reason, or anything else, just sort of about your experience since you kicked us off.
Mhm. Yeah. So a traditional investor-backed search fund, which is what I am, has a typical acquisition timeline of around 2 to 2.5 years. On average, it takes at least 2 years to really find and close that business. And Stanford University does a great study every 2 years to kind of publish that data. And in general, that doesn't change. There are lots of businesses out there. There aren't necessarily lots of good quality businesses that are a right fit for someone like me to come in and help grow and scale in the long term. So a lot of the challenge is finding that fit and finding the right owner that really believes in the vision they have for the business and is willing to hand that and trust that with someone else to really grow and scale out in the long term, versus choosing a different partner that would perhaps overemphasize the financial capital that the owner would kind of gain as part of that process. So we'll be running at least till the end of the year, and then I might have to go back to the drawing board, Joshua, and find a different way. For me, this process is about finding a way to invest in people, to use their skills to solve a real problem in the world. And acquisition is one way of doing that. But I could also step into a COO or a CEO role of a company without acquiring it necessarily, and then partner with the existing ownership structure, whatever that looks like, to really add value to the business. So I'm very open to achieving it in different ways through doing that. But going back to your second half of the question, we came very close to one business. It was a healthcare software business. They focused on the exchange of patient information between kind of different parties in the ecosystem. And the healthcare ecosystem is very inefficient in how it sends and exchanges data. So, Joshua, if you were to go to the doctors and they were to refer you to an X-ray, that process can actually be quite archaic, with them having to send that information to a third party. Maybe you're going somewhere externally to have the X-ray done, and then that X-ray is going to someone else to read before it comes back to your doctor as part of that process. And they sat in that process to help facilitate that communication and make it a little bit easier. We got about a month away from closing, had some really good conversations with it, but ultimately decided not to move forward with that acquisition. And someone else came in and bought that a couple of months later. So we were really excited for the owner because they found a good fit in someone else as a partner that allowed the business to continue growing and scaling, but it didn't end up being the right fit for us as an organization.
So we've had some situations where we've been asked to do some hiring where, founder built and led companies, and companies done quite well, but they kind of leave a leadership gap because they have a lot of talented people, but maybe the people are siloed and know their piece, but then the founder is the only one who knows how the pieces fit together. Or I think there's lots of examples of, founder does a deal and then, or even the owner, but then they kind of almost sabotage post closing because they're no longer. It doesn't seem to make sense because usually most of these deals have earnouts, and it's in their interest to have the business be as successful as possible. But and maybe it's subconscious decision making that they do or behaviors that they take on. Mm-hmm. But I'm just curious, like, did you have any deals where maybe you walked away because you were concerned about those types of things? Or just curious if you have any other observations around kind of, not just the metrics, but how do you decide if a founder is going to be a good partner to work with?
Yeah. We talk to owners who are both working with an investment bank or a broker. So there's been some intention around a sales process, but we also work with owners who we're approaching for the first time, and maybe they haven't thought about selling yet and really kind of thought through what that means. And good investment banks and brokers will help people think through the emotional and psychological side of selling a business, rather than just focusing on the business fundamentals. Because for a lot of the people that we connect with, they've been running this business for 20 or 30 years. Their identity, their sense of self is wrapped up in being the founder and CEO of XYZ company. And if they haven't mentally thought through kind of the day after I sell this business, I am no longer the CEO of this business, and I take a lot of significant significance in being of this business. Who am I after I've sold this business? Then that can often derail, and often that waits till the very end of the process for that to happen. I had an example that a friend shared with me where she was working with a client who was about to sell their business. And then a week before they were closing, he shared with his wife his vision to sail around the world after they sold the business. And his wife turned around and laughed at him and said, "I'm never going to do that." So the owner went from being 100% committed to the sale, because that allowed him to unlock his vision of going and sailing around the world, to suddenly trying to sabotage the deal because he'd lost that certainty around what comes next and what happens next. So I also encourage the owners that we work with to meet with an executive coach as part of that process during the diligence process, to really make sure they're thinking through, what does this sale mean to me? Why am I doing this? And what do I value? Because the other thing the data shows us is 70 to 80% of owners regret selling their business a year down the line. And some of that is down to the terms they got as part of the process. You've mentioned earnouts, which are often higher level than the business can really meet and sustain. So they go into the process expecting one amount, and then they come out of the process a year later with a significantly smaller amount because they didn't meet the earnout criteria and they lost a large portion of that enterprise value. So a lot of times it's kind of down to structure, but I think it's also down to who they sell to and how aligned they are with what they want to do with the business. Because every owner will care about more than just the check that they're cashing. If you walk away from the business with a big check, but all your employees lose their jobs, you're going to feel that. And if you haven't thought through the consequences of that and the impact of that, that's going to weigh on you quite heavily. Equally, if you sell to a competitor and then they decide that some of your customers are not worth servicing anymore, those customers have lost their relationship with you, and that relationship that you've had for 20, 30 years has certainly gone down the drain. Now, if you value that, you've got to include that as part of the process when you're negotiating the deal and when you're discussing who you want to sell that business to. And a lot of people don't invest the time in thinking through, what do I truly value and what do I want to get out of this sale process? Because they have to sell eventually. We don't kind of stay around forever. We can't kind of run a business forever. So that transition has to happen at some point in time. And that happens much more successfully when people have taken the time and energy to really think through what they want and what's important to them, and be of sound mind to run that process rather than waiting until the last minute where they're almost carried out by a coffin at the end of the process.
So you mentioned, part of your skill set being ability to create operational efficiencies and finding other ways to enable business to scale. And even just in the period since you started this, obviously there's a tremendous amount of evolution in automation, AI, et cetera. Do you have certain tools and approaches that you kind of bring to every case, which you'd likely use in any business you go into, or is that something you kind of more have to approach on a case-by-case basis? I mean, obviously, if you're buying a manufacturing business versus a software business versus, I don't know, a professional services business, there's probably automatically going to be some different tools and thinking that you would have to apply. But I'm just curious if you have any thoughts on that.
Yeah. I would say we have a toolkit, and then we look to draw from that toolkit what's needed in the business. And that order and priority might be dictated by the business as well in terms of what it needs. So a framework I like to bring in is the scaling up framework. It used to be called Rockefeller Habits. And that's just, what are consistent things that all businesses need to be doing to give them a solid foundation to enable the business to scale. Now, if we work with a business and they're already using a different framework, maybe EOS or System and Soul or something like that, then we're not going to rip out what they're doing and replace it with my preferred framework. We're going to work within the context of what the business has and pull in the tools that we need to really kind of adjust the lever. For me, it always starts with the culture, values, and purpose of the organization, because we want to align everyone around the same goal and the same direction that we're heading. And that's the hardest thing to do if you're trying to kind of work on revenue or increase revenue or maybe reduce costs. If everyone's not aligned on the direction that you're heading and where the business is going, all those other levers are much harder to pull. I also think they're the primary foundation of all the other metrics we tend to measure more quantifiably is the culture of the organization. And foundational to that is really having a consistent vision, understanding the values of the organization and how that drives decision making and the behaviors that we expect everyone in the organization to exhibit. Because if we can align around that and everyone's on board with that, then we can focus that time and energy in the right direction within core areas of the business that really needs to grow and scale. So if it's a manufacturing plant, we might bring the lean toolkit in to really understand where is waste being created, where are the bottlenecks within that process, and how can we unlock that. But equally, if you're operating at 20% of capacity, really cutting kind of operational cost or waste within that process is not going to make a real difference. You really want to focus on increasing revenue and increasing sales to really make sure you're hitting that capacity so you see the value of those operational changes. And there might be value in kind of making some efficiencies to make that process run sooner, but you're not going to feel the pain of that until you reach a scale that you've got enough revenue coming in. And a lot of the organizations we connect with and have conversations with haven't invested in that sales and marketing function, usually because the founder has played that role. They come from that industry, they come from that background, they understand that process, and therefore they've been driving a lot of that. But the problem is that one person doesn't scale. So they've never hired that one salesperson to help that business grow beyond what that one person's capacity can do. And also to help the business continue growing when the owner has to refocus on a different part of the business. Say a machine breaks down, they've got to jump in and help fix that problem. Suddenly the pipeline drops off because the owner is the only one driving that and doing that. So we would bring in a sales approach and bring in some sales resources as well as myself to help lead and drive that in the organization. So that enables the business to scale and then narrow down.
So before we wrap up, just a couple questions around sort of the people aspect.
Mm-hmm.
So, one is obviously sort of preserving institutional knowledge. Another is, if maybe there are some obvious gaps where you need to bring in new talent, but, in the middle, you've maybe got sort of others in leadership besides the owner,
Mm-hmm.
And then all the way down through the organization. And, anytime there's a leadership transition, that's going to cause uncertainty. So I'm just curious if you have a particular approach to people. And then sort of the second part of that question is, again, it seems like we're in an environment where, new metric is like, revenue per hire or revenue per head count and doging and this and that and the other. So I'm just curious if you have any thoughts in particular about sort of that balance of, talent and technology.
Mm-hmm. Yeah, 100%. We look at kind of each role on two dimensions. The first is that cultural fit with the organization. This is the most important dimension because if you've got someone who isn't aligned to the culture of the organization and positively contributing towards that, they're actually working against you within that ecosystem. The other dimension we look at is that skills or that talent dimension. So we'd love people to be in the top right, a strong cultural fit and a strong skill set. But a lot of the time you have people who are strong cultural fit that might not have the skills that they have in the organization. Now, some buyers will look to get those people out of the organization as quickly as possible. We look at it from a slightly different angle. If these are the right fit for the organization, then skills can be taught and they can be developed. And if that person isn't able to develop those skills, then there's probably a different part of the organization that they may be better suited to, that they can use the skills they already have in order to add value. So we take a bit of a strength-based approach. We like to leverage tools like Clifton Strengths to really understand kind of what are people's natural talents? What are they good at? What do they enjoy? What do they get fulfillment at? And how do we connect that with a role in the organization? So they can spend 80% of their time doing what they really enjoy doing and getting energy from that, and only 20% of their time working on the stuff that we all have to do in our roles that we don't necessarily enjoy. So we try and align those together to really add value in the organization, which again comes from a longer term approach to value creation. I don't have to sell this business for 5 times the amount in 3 to 5 years. So I've got the time to invest in employees and build up that human capital within the business in a way another buyer with different targets and a different ethos doesn't necessarily have the time to do. And then I want to touch on AI, Joshua, because you did mention it earlier. AI is great for efficiency, but the problem with AI is it's not a human being. And you and me, we both know we know when we're talking to an AI. Even in GPT-5 that came out quite recently, I know I'm talking to an AI, and I know the context within that, and it feels less human. So I think there's definitely an emphasis that we bring on where do we add value as human beings? Where do we bring value in the human touch within this process? And where do we offload the repetitive tasks that none of us really enjoy doing? So we focus more on that 20% of the role that you don't enjoy. How can we bring in AI to make you more efficient? So you're spending 80, 90, 100% of your time on the work that really needs a human being to add value. It requires a relationship to build trust and to kind of engage in that process. And then we hand off to AI the grunt work that we don't really want to be doing. What I find really interesting is there's lots of sales tools that use AI that try and replace the human salesman. And all the data suggests they are very good at generating leads, but they don't close anything. So here's an interesting part of the process. If we used AI to generate the leads and then we handed that off to a human being, our close rate would be much higher because we're taking off that admin part of the role that salespeople really don't like. A high volume approach, if that's required for your industry, or a relationship driven approach, which I don't think you can offload to AI, but we're bringing the human into the process to really build relationship, understand the unique needs of that customer, and really align whether our solution is right for them to then close the sale. And I think that's something that AI will continue to struggle to do because it's very different to a human being in how it approaches some of these tasks.
Yeah. Well, Andy, anything else you'd like to share before we wrap up?
Just if anyone's interested in finding out a bit more or following me on LinkedIn, I talk a lot about how do we build culture and how do we bring some of these tools into our businesses. So if you're running a business and you're interested in how you can kind of help scale your business, then feel free to find me on LinkedIn. I'm Andrew D. Galpin on there, and happy to connect and talk with people who are interested in driving more positive change in the world through the vehicle of business.
Great. Well, Andy Galpin, founder Tree and Leaf Partners.